I'm Sebastian St. James. Australians need this superannuation system. Today we'll be discussing the perfect superannuation system for all Australians. Importantly, it must work for the cleaner who's on $40,000 and the manager who's on $200,000 equally well. As well as revealing to you what this superannuation system is, you'll also learn a lot about the current Australian superannuation system as we go. This is Mildred. Mildred wears a badge, so it's easy for me to remember her name. I can't be certain, but I think Mildred may have been born a man. Or perhaps she just has naturally hairy arms. Who could say? Mildred is a lunch lady. She earns $38,000 a year and she loves Neil Diamond. Oh. This is Candy. Candy is a secretary who loves taking dictation. That was phased out in the 90s. Tell your boss to write his own emails. So, Candy is a secretary who earns $50,000 a year and she loves, doing overtime with her boss. What a diligent worker she must be. This is the Don. Don treats his workers like family and he has them call him Godfather. Well, that's unusual. The Don, his occupation is boss. He earns $250,000 a year, or so he says. He loves helping people sleep with the fishes. Perhaps he works at an aquarium. My job is to create the perfect superannuation system for Australians that work equally well for Mildred, Candy and the Don. One of the advantages of the current Australian superannuation system is its reduced tax rate. I mean, if you didn't have that tax rate, why use it? So the tax on superannuation is 15% up to $250,000 of earnings for contributions and earnings within the superannuation fund itself. So that's a flat tax, 15% across the board. But that's not how taxes work on income. You'll notice if you earn up to $18,200, you actually pay no tax at all. There's a 19% tax bracket, 32.5%, 37% and 45% tax bracket if you earn over $180,001 per year. So you'll see, the income tax for Mildred is 19%, but the super is 15%. For Candy, it's 32.5%, but her super is 15%. And the Don, his normal income tax rate is 45%, but his super is 15%. With the Australian taxation system, everybody pays a different percentage according to how much they earn. With superannuation, no, magically, everybody just pays the same. The problem with this is it disproportionately benefits the wealthy and not so much the average person. So the tax saving in super for Mildred is only 4%. For Candy, it's 17.5%. And Don, who earns the most amount of money by far, he actually saves 30%. So with the current system, the more money that you earn, the bigger your tax savings are. Oh, fancy that. In the world, there are two types of tax systems. What are they? Well, there is a flat tax. In Australia, we have super and GST. A flat tax basically means everybody pays the same. And a progressive tax, such as income tax. This is Hapless. She is a hairdresser and a single mother with 2 children. So Hapless earns $18,000 a year. She's taxed at 0 because she comes under the tax-free threshold. Her food and rent costs alone add up to $18,000, and then after her basic expenses, she's left with absolutely nothing. Which, if you're earning $18,000 a year and you've got a child, I'm not surprised there's nothing left over. This is Tycoon. He is single and an investment banker and has no children. So Tycoon earns $200,000 a year. He's taxed at 45%. His basic food and rent cost him $100,000 a year. So after expenses, he's left with $900,000 a year. A progressive tax system acknowledges that there's some people who are on lower wages who basically every penny that they get in the door has to go out straight away on food, rent, basic expenses, whereas other people on higher incomes, it's not that way at all. They've got discretionary money. So the idea of a progressive tax system is that the people on the lower income don't pay as much tax because they really just can't afford it. And the people on the higher tax rate, they can afford a bit more. Society needs a bit more. And therefore that is how it works. But not with super. Change number 1 that I'm proposing is that you tax super at a progressive rate while still giving a tax discount. For example, a 46% of marginal tax rate. A progressive tax system is fair because those who are lower income really just can't afford to pay as much tax. But we need to spread that over to super as well, plus maintaining the incentive. If you didn't have a tax reduction, then why invest in superannuation in the first place? So I think we can do both at once. So I've chosen 46% and I'll show you why. So Mildred, who was paying 15% tax on her super, would be moved to a 9% tax. Okay, so it would benefit her and give her a little bit more money when she retires, which she'll desperately need. Candy, on the other hand, she stays exactly the same at 15%. Don, who was paying 15%, now is bumped up to 21%. Okay. There are two basic types of superannuation systems throughout the world. There is defined benefit and defined contribution. In a previous video, we discussed them in detail. Here, we'll just briefly go over them. With a defined benefit superannuation, you're guaranteed a payment of X thousand per year when you retire. It's indexed with inflation for the rest of your life. That's what a defined benefit system gives you. You know exactly how much you're going to get. There's no gambling on the market. Plus, it will last you for the rest of your life. So maybe you thought you were living till 82, ends up you're living to 92. Doesn't matter. The defined benefit system will keep paying you out. With a defined contribution superannuation system, you're guaranteed a contribution of X% per year. That's the guarantee part. Depending on the share market and your investment skill, for which you have no training, the average person certainly doesn't, you'll retire with, I really couldn't say. And it could run out by the time you're 75. And whoops, you ended up living to 95. Too bad, you've run out of money. Defined contribution super plans actually have pluses and minuses to them. They're not bad, they're not good inherently, but it does tend to benefit the wealthier individuals and not so much the lower end of town, and there's a reason for that. For instance, your final balance for a defined contribution system, if you're on a very low income, you may only end up with 40k if the market goes wrong, or you could end up with 200k. If you're getting a pension plus 40k is not enough to spend for anything, and that's for the rest of your life. Let's say you've been a mother and you've only had a part-time job. It's feasible that you only end up with a certain amount of money and then the market crashes and it turns into 40k. That's not enough to spend with anything. You will not even cover your basic medical expenses. Do you know that when you're a pensioner, there are certain things you have to pay for yourself? Not everything is bulk billed and therefore you need some real money. But on the other hand, 200k, it's not a lot, but it can certainly give you an entirely different lifestyle. Perhaps you can afford one coffee a week. If the amount that you have in super is going to put you right on the poverty line, then you cannot afford the roll of the dice of the market. On the other hand, the final balance for a higher income individual, well, if the market goes bad, it could be $3 million. If it goes well, it could be $5 million. That's the yin and the yang of defined contribution system. If the market goes well, you do particularly well. If the market crashes, you do particularly worse. So with defined contribution schemes, and if you're a lower income earner, can you afford medical expenses or not? We don't know. It depends on the market. With a higher income, is it one yacht or is it two? Such a decision. Is there an upside of defined contribution plans? Well, yes, there is. Defined benefit plans tend to be based on a fairly conservative return in the market. So, if you can get control of your own money through self-managed super fund and its defined contribution, so the money's coming to you, then you can potentially outstrip a defined benefit plan with a defined contribution plan and end up much better off. Of course, if the market goes down and you tank, you won't be so well off, but it doesn't matter. You will survive either way. So for wealthier individuals, defined contribution plans can be a lot better off for them. So change number 2 I'm proposing would be give workers the choice of being in a defined benefit plan or a defined contribution super plan. It's totally up to you. As it turns out, Mildred has decided to be in a defined benefit plan. Candy has gone half in a defined benefit plan and half in a defined contribution plan. Yes, you could do that under my system. And the Don has gone 100% in defined contribution plan. In Australia, superannuation fees are currently ridiculously high. For example, some funds I randomly brought up for $50,000, which is the standard amount that these tables tend to be based on. Crescent Wealth will charge you $1,134 a year in fees alone. Superhero $998 and Verve Super $810. So for a super balance of $50,000, as I said, that's a standard comparison amount. Your fee could be $1,134 or 2.27% every year without fail, going right out the door. Let's say I take that same $50,000 a year, put it in my own bank account, open a brokerage account and invest it, say in the IVV. How much would that cost me? Well, the IVV has a management fee of 0.04%. If I take that same superannuation balance, if I'm not buying anything and I'm just continuing to own it, then the brokerage will be zero. IVV, the ETF, will cost me $20 a year or 0.04%. The same amount in super was 1,134 or 2.27%. That amount is ridiculous. Australians are forced into a superannuation scheme. I have no problems with saving towards your future, but for what can cost me $20 a year, apparently it costs me well in excess of $1,000, and that I cannot accept. The question is, why can't I invest my super in my own name? Because of compliance rules. The government does not allow that. But what about an SMSF? A self-managed super fund. Isn't that in your own name? No, that is a trust, and therefore it's not technically in your own name at all. Sure, you may have control over how it's invested, more so than if you invest in a super fund, but you don't so much have control over the expenses. How much does it cost to maintain a self-managed super fund? With estimates ranging from nearly $14,000 a year to below $4,000, those considering taking the plunge and establishing their own SMSF could be forgiven for being a little confused. The fees on our super balance of $50,000 with an SMSF could be, say, $3,000. The way the costs work out for super in Australia is this. If you've got a modest amount of money, as far as the fees are concerned, you're probably better off not running a self-managed super fund. If you've got a lot of money, you'll definitely save on fees. So you tend to find that the wealthy go for self-managed super funds, the average person goes for a superannuation fund, and if for no other reason, it's to reduce the fees. But if you give me $50,000, I can reduce the fees even further. And that's by holding direct shares. If I just buy shares under my own name and hold them, it will actually cost me nothing. $0 a year for the rest of my life while I hold them.
Counterpoint, people cannot be trusted with their own super. If you're allowed to have superannuation under your own name, people would simply spend it and there'd be nothing left.
This is Flora. Flora is a florist. She earns $125,000 a year. Her business structure is a sole proprietor. Do I need a separate bank account for being self-employed? If you're self-employed, you do not need to register a business account because you're a single trader. So although Flora earns $125,000 a year, is running a registered business, which means she has an ABN, she is allowed to stick it in her own personal bank account. If you run a business under your own name, it's recommended that you actually have a separate account. But legally, you don't have to. You can actually put it in your everyday transaction account if you wish. So for a self-employed person, can you use a personal bank account? The answer is yes. Must you pay for an audit? Oh, the answer there is no. If the ATO suspects you've been cheating, they may audit you anyway, but a tax system in Australia is based on the honour system. You could do your own tax. You do not have to have anybody check it over for you. You do not have to prove anything. With the self-managed superannuation system, can you use a personal bank account? The answer is no. It has to be in a trust. Must you pay for an audit or compliance fees? The answer is yes, absolutely you do. Well, this is weird. Why do we trust self-employed people to be able to manage their own taxes and manage their own money under their own name, but when it comes to super, we don't? That is because of this. There is the CDPP, which stands for the Australian Federal Prosecution Service. Interesting. Tax fraud. We prosecute a significant number of tax fraud matters, including refund fraud matters and taxation evasion frauds and schemes. We prosecute taxation fraud and regulatory offences referred by the ATO. We also prosecute serious tax evasion schemes referred by the Serious Financial Crime Task Force, as well as matters referred by the AFP and the ACIC. So apparently if you give a big stick, people can magically do their own taxes in their own name. So have the same system for the superannuation. So change number 3 would be allow people to manage their own super at a cost of potentially $0 a year. Wow, wouldn't that be nice? Super fraud would be a crime, just as it is with tax. Apparently it works quite well with tax. What about using your superannuation system to fund your PPOR, your principal place of residence, before you retire? Renters beware how the pension and super could leave you behind. If you rent, you are highly likely to live in poverty in retirement. If you own your own home, the pension and the super will probably be enough for you. If you're on the pension, you're eligible for what is called rent assistance. How much is it? Enough to cover your rent? No, it's not. The maximum amount of rent assistance you can receive if you're on the pension is $142.80 per couple combined. So $142 per week? No, that is per fortnight. Chop that in half. Let's see how far that would get you in the rental markets. So in Sydney, the medium house rental, so this is not for anything expensive at all, is $640 per week. In Melbourne, it's $460 per week. So here you are, you've retired without a house. In Sydney, it's going to cost you $640 in rent. The government will pay $71.40 of that. In Melbourne, it'll cost you $460 and the government will pay $71.40 of that. So in conclusion, you won't be able to afford to rent if you're on the government pension. Sad, but that seems to be the way it is. Okay, so that cohort of people would never have been able to afford their own house in the first place. But what if you can? What if you've got enough money right now in your super that you could actually go out and buy a house? Can you? Can I use a self-managed super fund to buy a house to live in? You may have heard about people using their superannuation to buy a house or other property within a self-managed superannuation fund. While this is possible in some circumstances, it must be for investment purposes only under arm's length arrangement. If you have a self-managed super, potentially you can buy a house, but you can't live in it until you retire. And how exactly does that work? What happens to my SMSF investment property when I retire? So you could do one of two things. You can wind it up, put it to cash, or down to the yellow bit. For the purposes of this article, you need to do what's known as an in-specie transfer, meaning your SMSF transfers its asset to you as it is. So rather than your SMSF owning the property, you're now the owner. Performing an in-species transfer means you may be able to afford stamp duty because it's already in your own name. Can you live in your SMSF property after you retire? Yes, of course you can. Okay, but what if I did not have a fancy self-managed superannuation fund and I just had a regular superannuation fund? How can I buy a house then? Well, once you retire, remember this can only happen after you retire, you then withdraw a lump sum from your super and you buy a house. Fairly straightforward. The question is, what about buying a house for you to live in before you retire? Does putting your superannuation money before you retire into an asset that actually gets no return back because you're not renting it out, but you live in it and hence it reduces your expenses now, valid? Well, if we look at the rental yield across all capital cities in Australia as of 2022 right now, the amount that you pay in rent on a 3-bedroom house is 3.2% of the worth of the house, so it's not a lot. So if you had enough in your super right now to afford to buy a house, you'd be saving 3.2% of that house, which is going out in rent costs every week. Or if you left that in super, you potentially could earn 9% on that. Oh, that's interesting, isn't it? Oh, so there's kind of pros and cons to this. That's right. If you can't live in a house owned by your super before you retire, and hence you have to rent it out, it's better for your super balance in the long run. But if you can live in a house that's owned by your super before retirement, then it's better for you now. So change number 4, I'm actually on the fence to whether allow people to buy their PPOR with their super money and live with it. So we could give people a choice, make up their own mind. So this is part of my system, bringing back choice into the superannuation system. The government right now says no. With the present superannuation system in Australia, you cannot live in your own house before you retire, even if your super plan owns it. The reason is they want the higher balances because you'll be less dependent on the pension and it will potentially cost them a whole lot less. And that's what they care about. The last change I want to make is to the superannuation guarantee amount. How much are you getting paid now? The percentage rate of superannuation guarantee contribution payments by your employer is currently, as of this video, 10.5%. The SG increased from 10% to 10.5% as of the 1st of July, and it's set to rise again to 11% on the 1st of July 2023. The SG percentage rate will continue increasing by 0.5% every year until it finally tops out at 12% in 2025. So, 10.5% now, eventually going up to 12%. I guess politicians are on the same rate, aren't they? Definitely not. Labour superannuation spokesman Stephen Jones will accuse Mr Morrison, this article would have been written a few years ago, of breathtaking hypocrisy for taking 15.4% super while pondering scrapping a 2.5 percentage point bump in SG rate. It's one rule for the cleaners, shop assistants, mine workers, tradies, and another rule for themselves, Mr Jones said. So the super rate for you is 10.5%, eventually getting up to 12%. For politicians right now, it's 15.4%. So apparently 15.4% is the amount that you need in your super, but not for you. You don't deserve it. So my last proposed change is to make 15.4% standard for absolutely everybody. If that's what the politicians need, we all need that. Do you know that pensioners today are much worse off than they used to be? Is that true? Click here to find out.